Let's now look at illustration number 3. Entity XYZ enters into a forward contract to purchase 1 million ordinary shares of entity T in a period of 1 year. The current market price is 50 per share. The 1 year forward price of T Limited is 55 per share. Now, what does this mean? Basically, entity XYZ has entered into a contract to purchase 1 million shares of entity T Limited after a period of 1 year, but the price is actually fixed today. All right, so XYZ has entered into a contract to purchase 1 million shares of T Limited after 1 year at a price of 55 per share. The current market price is 50, but the forward price is determined as 55 per share. So 1 year later, entity XYZ will receive the shares and it will have to actually pay 55 per share. All right, so entity XYZ is expected to have an outflow of 55 per share after a period of 1 year. Now, instead of actually making the 55 rupees payment after a period of 1 year, what entity XYZ has decided is XYZ will actually prepay the forward contract at the inception itself. What XYZ is actually telling the counterparty is, I have to actually pay you 55 1 year later. Instead of that, I will actually pay you the present value of 55, which happens to be 50 million. All right, 55 per share multiplied by 1 million is 55 million. What entity XYZ is telling the counterparty is, instead of paying 55 million 1 year later, I will pay you 50 million today itself. I will pay you 50 million at the inception of the forward contract. All right. So instead of paying 1 year later, entity XYZ is going to pay the money today itself. And 1 year later, XYZ will only receive the delivery of the shares. There will be no additional payment that is required to be made. All right. No additional payment is going to be required to be made because the payment has been done at the inception itself. The question is this forward contract going to be regarded as a derivative or not? All right. Will entity XYZ consider this forward contract as a derivative or not? Now, for any contract to be classified as a derivative contract, one of the conditions that are required to be satisfied is the initial investment is supposed to be either nil or it is supposed to be very low. All right, the initial investment is either supposed to be nil or it is supposed to be low. Now, in this question, entity XYZ is actually having an initial investment of 50 million. Entity XYZ is having an initial investment of 50 million. The question is this 50 million actually satisfying the condition of being a low initial investment or is it not low? All right, we have to actually find out whether this 50 million that XYZ is paying fulfills the criteria of being a low investment or not a low investment. Now, how do we determine that? What the standard says is, compare this outflow that you're having under the derivative market. To enter into this position, you're actually having an outflow of 50 million. Compare this outflow to the outflow that you would have had to actually enter into a similar position in the spot market. All right. Compare the derivative contract outflow with the outflow that you would have had to actually make to enter into a similar position in the spot market. If this outflow under the derivative contract is a small percentage of the outflow that you would have had to make under the spot market, then it satisfies the condition of low initial investment. All right, I'm repeating myself. If the amount of outflow under the derivative contract is a small percentage of the outflow that you would have had to incur for the purpose of entering into a similar position in the spot market, then the initial investment is low. Otherwise, the initial investment is not said to be low. If the initial investment is low, then it will be classified as a derivative contract. If the initial investment is not low, it cannot be classified as a derivative contract. All right. So we compare the outflow under the derivative market with the outflow for a similar position in the spot market. And if the percentage is low, if the percentage of outflow under the derivative contract is a small percentage, then it satisfies the definition of low initial investment and will be classified as a derivative. Otherwise, it will not be classified as a derivative. Now, what does this mean? To enter into a similar position in the cash market or in the spot market, the amount of cash outflow that I will have to enter into a similar position in the spot market is actually rupees 50 multiplied by 1 million. Instead of my derivative contract position is basically to purchase 1 million shares after 1 year, a similar position in the spot market would mean to purchase 1 million shares today itself. All right. Spot market basically refers to the actual stock exchange where you're immediately buying and selling shares. All right. So comparable contract under the derivative, I had an agreement to purchase 1 million shares after 1 year. Comparable position is basically in the cash market or in the spot market. I purchase 1 million shares today itself. The outflow that I would have had to purchase 1 million shares today would be 50 multiplied by 1 million, which is actually equal to 50 million. All right, 50 multiplied by 1 million is going to be 50 million rupees. All right, so the amount of outflow that I would have under the cash market or the spot market and cash market refer to the same terms. So to purchase 1 million shares today, I would have incurred an amount of 50 million, and to actually enter into the derivative contract also, I'm actually spending 50 million. So my outflow under the derivative contract is actually 100% of the outflow under the cash market or the spot market. The outflow under the derivative market is 100 percentage or is the same as the cash flow that I would have to actually make to purchase the position in the spot market. Therefore, you cannot classify this as derivative. The cash flow under derivative contract, cash flow of derivative contract divided by the cash flow of spot contract is actually equal to 100 percentage. Spot contract basically means if I purchase the position today, what would be my cash outflow? Cash flow under the derivative contract is the 50 million that is actually given in the question. What the standard says is this percentage is supposed to be a low percentage. All right, it's supposed to be a small percentage, or ideally it is supposed to be zero. It's either supposed to be zero or a small percentage, and over here we are actually having 100 percentage. So which means that the initial investment is not low. The initial investment under the derivative contract is not low, and therefore this will not be classified as a derivative. This forward contract will not be classified as a derivative. All right, we are not going to classify this as a forward contract. Instead, we are actually going to record the journal entry as investment in equity shares. I am actually going to record this as investment in equity shares today itself. I'm not going to record this as a derivative contract. I will be recording investment in equity shares to the tune of 50 million, and I will credit bank by the amount of 50 million. All right, so I am going to record the investment in equity shares. Ideally, if this was a derivative contract, I would have debited derivative asset. I would not have debited investment in equity shares. But because this is not a derivative contract, it fails the definition of being a derivative. Therefore, today itself, I will be recording the investment in equity shares. I'm going to record the investment in equity shares at 50 million rupees. All right. So this is the case where a forward contract is prepaid, and therefore it fails the test of having low initial investment. Now, if you actually think of it, a slightly related topic is what I would like to touch. In case of option contracts, as an option buyer, let us say I buy a call option, I am usually required to make an upfront payment in the form of premium. All right. So I actually have a net initial investment. I actually have a net initial investment in the form of premium that I have to actually pay to the seller of the option. What typically happens is, let us say I have the market price per share. Let's say I have the market price of share as rupees 100, and I also have the strike price as rupees 100. Let's say I also have the strike price as rupees 100. All right. And if let's say the time to maturity is 3 months, if the time to maturity is 3 months, the premium would usually be, let us say, rupees 10. All right. I'm hypothetically obviously creating my own numbers, but let's say the premium is 10. Now, if you actually compare, the cash flow that I have under the derivative contract is actually equal to 10. The cash flow under the derivative contract, I have purchased the call option. The cash flow under the derivative contract that I'm actually having is rupees 10 that I actually have to pay to the option seller. Now, to get a similar position in the spot market, all right, a call option basically gives me an ability to buy the share. All right, to get a similar position in the spot market basically means to buy the share in the spot market. The cash flow that I'm going to have, the cash flow under the spot market is going to be actually rupees 100. All right, the market price of the share is rupees 100 today. So to purchase a share today, I am actually going to have a cash outflow of rupees 100. Therefore, the cash flow under the derivative contract is 10 10%, and this actually satisfies the criteria of low initial investment. All right, this satisfies the criteria of low initial investment because my cash flow under the derivative contract is rupees 10. I had to pay a premium of rupees 10 for purchasing the call option. The call option gives me an ability to buy the share at a future point. Therefore, under the spot market, for me to actually purchase the share in reality, I would have had to spend 100 rupees. Therefore, my outflow under the derivative contract today, all right, my outflow today, I obviously after a period of 3 months, I will have to pay 100 under the derivative contract also. But what we are actually going to see is the initial investment. The cash flow under the derivative contract initially is only rupees 10. At a later point, I will have to pay 100, but that is not of relevance for me under the derivative contract. Today, the cash outflow is only rupees 10. Therefore, for me, I will be comparing this rupees 10 with the outflow that I would have had to purchase a similar position in the spot market, which is 100. And therefore, this satisfies the criteria of low initial investment. I'm only taking the initial investment under the derivative contract in the numerator to determine whether the initial investment is low or is not low. Since it is low, we will actually classify this option contract as a derivative contract. All right. So options, although they have a small have an upfront premium that are required to pay, typically the premium is going to be a small percentage. Generally, the premium is going to be a small percentage of the outflow that you would have had under the spot market, and hence options satisfy the definition of derivatives. All right. In extreme cases, let us say if the premium is very high and is actually, let's say, 100 percentage of the cash flow that you would have had under the spot market, then obviously over here also you would actually not classify it as derivative. That would be in an extreme circumstance, but generally premiums are a relatively small percentage of the spot market price, and hence it would satisfy this condition of low initial investment. All right, with that, we're done with illustration 3, and I also explained how options actually satisfy the definition of derivative contract as per Ind AS 109.